In 2002, America was still trying to recover from Enron. The country believed it had already witnessed the biggest corporate fraud in history. Then investigators opened the books of another company. What they found was even worse. Not millions, not billions hidden offshore. Instead, executives had simply rewritten reality. With a few accounting entries, they transformed losses into profits. They convinced Wall Street a dying company was thriving. Investors poured in billions. Employees invested their retirement savings. Banks kept lending money. And nobody realized the numbers were fake. By the time the truth surfaced, over $11 billion had vanished from the company's financial statements. More than 30,000 people lost their jobs. Investors lost over $180 billion in market value, and the company behind it all was one of the largest telecommunications businesses on Earth. This is the forgotten story of WorldCom. Long before smartphones, before high-speed internet, America's phone companies were fighting for control of the future. One company seemed to come out of nowhere: WorldCom. It began in Mississippi during the 1980s as a tiny, long-distance reseller. Its CEO, Bernard Ebbers, wasn't a Wall Street executive. He had once owned a motel. Friends described him as quiet, religious, and obsessed with growth. Rather than build new technology, Ebbers bought competitors, again, and again, and again. More than 60 acquisitions in little over a decade. Each purchase made WorldCom larger. Its stock price climbed. Wall Street loved the story. Growth became an addiction, because once investors expect constant growth, anything less feels like failure, and eventually, WorldCom stopped growing. That was the moment everything changed. By 2000, the internet bubble was bursting. Telecom companies had built far too much fiber optic cable. Competition exploded. Prices collapsed. WorldCom's revenue stalled. There was only one problem. Wall Street wasn't expecting slower growth. Analysts expected bigger profits every quarter. Missing expectations even once could wipe billions off a company's value overnight. Inside headquarters, executives faced impossible choices: tell the truth, or keep the illusion alive. They chose the illusion, but they needed a way to manufacture profits without actually earning any money. The answer came from an accounting trick. Almost nobody outside finance understood. Every business has expenses: electricity, rent, employee salaries. For WorldCom, one of the biggest costs was paying other phone companies to use their networks. These were called line costs. Normally, these costs should immediately reduce profits. Instead, executives did something astonishing. They simply stopped calling them expenses. They reclassified billions of dollars as long-term assets. On paper, nothing had changed. No extra customers, no additional revenue, no new technology. Only a few entries inside an accounting system, but suddenly, quarterly profits magically appeared. Losses became gains. Investors celebrated. Wall Street applauded. The company reported success. That never existed. The fraud sounds obvious today. So why didn't anyone catch it? Because everyone trusted someone else. Auditors trusted management, investors trusted auditors, banks trusted financial statements, analysts trusted earnings reports, employees trusted the stock price. Everyone assumed someone else had verified the numbers. Even regulators overlooked warning signs. Meanwhile, the fake assets kept growing. Billions, then more billions. Every quarter required another lie to cover the previous one. The fraud had become too large to stop. If executives admitted the truth, the company would collapse instantly. So they doubled down. Again and again, until one internal auditor asked a simple question. Her name was Cynthia Cooper. She wasn't trying to expose one of history's biggest frauds. She was simply doing her job. As head of internal audit, she reviewed unusual accounting entries. One number didn't make sense, then another, then another. She asked questions. Management gave vague answers. She kept digging, late at night, while executives were unaware. Her audit team secretly examined company records. What they discovered was staggering. Nearly $4 billion in ordinary expenses had been hidden as assets. And that was only the beginning. Every new file revealed even larger manipulation. The fraud wasn't an accounting mistake. It was systematic, intentional, and enormous. The evidence was undeniable. WorldCom's profits were fiction. June 2002. The company admitted it had falsified its financial statements. Wall Street panicked. Investors rushed to sell. The stock, once worth over $60 a share, collapsed to pennies. Employees watched retirement accounts disappear. Thousands lost their jobs. Suppliers weren't paid. Communities dependent on WorldCom offices suffered. Banks lost billions. The company filed what was then the largest bankruptcy in American history. Only Enron had prepared the world for a scandal this massive. But even Enron's accounting fraud was smaller. Throughout the investigation, one question remained. Did CEO Bernard Ebbers know? Prosecutors argued the fraud couldn't have happened without him. Executives testified against their former boss. Financial records painted a devastating picture. Ebbers had personally borrowed hundreds of millions of dollars using WorldCom stock as collateral. If the stock price fell, everything he owned could disappear. Keeping investors happy had become personal. In 2005, a jury found him guilty. He was sentenced to 25 years in federal prison, one of the longest sentences ever given to a corporate executive. Today, ask someone about corporate fraud. Most will say Enron. Some will mention Bernie Madoff. Younger investors might remember FTX. Almost nobody says WorldCom. Yet the scandal changed corporate America forever. It helped lead to the Sarbanes-Oxley Act, forcing CEOs and CFOs to personally certify financial statements, strengthening internal controls, and increasing accountability for public companies. Companies invested billions in compliance. Auditing standards changed. Internal controls became far stricter. The fraud literally rewrote the rules of corporate accounting. Yet, outside finance, few remember its name. WorldCom wasn't built on fake technology. It wasn't a Ponzi scheme. There weren't secret offshore accounts. The company simply convinced the world that expenses were assets. A few accounting entries created billions of dollars that never existed. For years, the deception fooled Wall Street, banks, auditors, regulators, even the employees whose futures depended on the company. Sometimes, the biggest frauds aren't hidden in complex financial engineering. Sometimes, they're hiding in plain sight. And sometimes, the scandals that changed history become the ones history forgets. And until next time, thanks for watching. Please, like, share, and subscribe for more Ledger of Lies.